The objective of the Global Reserve Currency Index, in fact, is to be able to manage your wealth against something which is global, something which represents the world economy.
So you recently co-wrote an article called Overcoming the Notion of a Single Reference Currency, a Currency Basket Approach. Why did you decide to write this article and what is it about?
Well, the single currency approach as a reference currency for us seems not to be enough now. To understand that, it really relates on our background. I'm running a company that has been managing currency risk for institutional and global family since 2000. And what we think is that today, because of the globalization of trade, because of the globalization of investment, the notion of a single currency is not enough. What is your fiduciary duty is to protect your wealth in the global economy, not just the economy of a single country or currency.
So in the article you mentioned Global Reserve Currency Index. What is that exactly?
The objective of the Global Reserve Currency Index, in fact, is to be able to manage your wealth against something which is global, something which represents the world economy. And to do that, we take the 15 largest economy in the world, their currency, that you have here on the pie chart, and a little bit of gold, and that is our what we call Global Reserve Currency Index. That means that if you take all these currencies, you are in fact taking 85% of the world economy.
So what's the best way for investors to manage their wealth in the long term?
The best way for investors is to consider their wealth not just in a country, but in the world economy. So if you want to protect your purchasing power, you have to put it in relation to the world economy. And the Global Reserve Currency does this function. What you have to say, what you have to look is, well, you have a principle which is not to put your eggs in the same basket. And let's suppose the basket is just one currency. Today, which currency I would like to be in the next 6, 12 months, 2, 3 years? It's very difficult. All currency have potential to appreciate, but also to depreciate. And it's very difficult to forecast them, as we have seen recently with, for example, the crash of the pound, and all volatility we had on the currency market. So the idea to diversify and to create a basket of the largest economy brings a lot less volatility. I show you that you are in fact investing in something which is diversified and represents the global economy, and the fact of hedging your wealth against that instead of against just a single currency means that you are not putting your eggs in the same basket.
So what's your take on the so-called currency wars dubbed by The Economist?
Well, the currency war corresponds to the fact that more and more central banks are trying to weaken their currency. Why? Just to boost their exports. But that means as an asset holder, I should be very careful on that, because I can completely wipe out the returns of my assets if I don't pay attention to my base currency, or at least the benchmark of currency that I'm looking at when I'm managing my assets. That's why the Global Reserve Currency is in fact answering this currency war environment, because we are not taking a bet on one currency or the other. What we want is to have diversification. And you have new players in the currency war game. One of the most recent one is the Japanese central bank, which is trying to make the most to have yen weakening. Before you had a lot of countries that were trying to do that. But you don't know, maybe next year it will be another country. Even the European Central Bank is happy to see the euro quite weak those days. But it could be tomorrow other countries, and even our Swiss franc, the Swiss franc, the SNB would be very happy to see the Swiss franc weakening. So when you see that this kind of environment, that makes currency management for us quite difficult if you want to select just one currency. Diversification is the answer. That's why. Currency war, yes, probably for a long time, But to counter the currency war, the best is the diversification.
Now, how can we use the currency basket approach in the Brexit environment?
Okay, well, we've seen the Brexit was a very unexpected event. And, well, who were the traders or the asset holders who were forecasting the Brexit and before June? What we have seen since December is a weakening of the pound. If you look at the purchasing power of sterling-based investors between last December and today, they've lost more than 20% of their purchasing power. So it's not negligible at all. And in fact, in June, it has accelerated the move, but the move was much older than that. Again, because British economy is probably one of the best in Europe, so that means really that globally speaking, currency are very difficult to forecast. You can have very special event like this, and again, that makes the case for diversification. We have some family office based in the UK. We're very happy to be invested more in the GRC than in just one currency, because they are saving up to 20% of their purchasing power when they go for holidays in the US or in Europe. And that's not negligible at all, especially that today most assets return are certainly not in the double digit area, but more in the single digit, even if they are not negative as we have on the bond market.
Well, thank you, Helie Deforts, for joining us in our studios again.
Thank you very much.
And thank you at home for watching this broadcast. We want to know how you found this programme, so give us a comment in the box below. Goodbye for now.